Hi, I'm Lawrence Parker-Brown. Welcome to the Inside Network. Welcome to the Inside Network's INDepth series. I'm delighted to be joined by Misha Mohl, Group Head of Strategy at HMC Capital. He's going to propose an interesting investment hypothesis as we look at Lend-Lease reaching 30-year lows. Let's just start more broadly, Misha. HMC Capital is a high-conviction portfolio. You're centered really on real estate assets, and that's hoping to capitalize on undervaluation across the market. What does your investment process look like?
Yeah, thanks. So you're referring to our Capital Partners Fund, which was a strategy we launched in August last year. And today that fund owns positions in Sigma Healthcare, Lend-Lease, as you mentioned, and more recently we've disclosed a position in a company called Ingenia Communities. Look, this strategy was designed with the purpose of providing investors with a differentiated strategy to, as you say, unlock opportunities in mispriced assets. And what I'm really referring to there is a private equity style approach to investing in the public markets. And maybe just to explain that further, I think what that means in reality is we're looking for really unique situations where we can leverage our team's very deep experience in terms of deal-making capability, networks and relationships to add value into our investee companies by being a really proactive shareholder.
You built up this position, Misha, in Lend-Lease. It's one of Australia's most recognisable brands, an amazing story, but for 30 years it's had its challenges. Could you give us some examples of why it's fallen so far?
Yes, as you say, Lend-Lease has been one of the worst performing ASX-listed companies over a 30-year period. It's been incredibly disappointed. There's obviously a lot of long-suffering shareholders. And I think one of the obvious reasons why companies' share prices typically underperform, it's because they fail to grow earnings per share. I think when we look at Lend-Lease over that sort of extended period of time, what's obvious to us is some really poor capital allocation decisions. And I think when we step back and look at it, that's really culminated in a business that became too complicated and really became an over-diversified conglomerate sort of business model and a business that became far too accident-prone.
And so let's drill into some of these acquisitions that they made over a 30-year period. You're talking about shrink to greatness. What's some of this fat that you're looking to cut?
Yeah, it's a great question, and that's absolutely central to our investment thesis in Lend-Lease. So, the white paper we published in August this year, a key part of that was major non-core asset sales. We identified their residential communities business as being non-core. They've got a 25% stake remaining in their retirement business. We don't think that business should still be within Lend-Lease. They also put a lot of capital into an asset in China, in Shanghai. We don't see a great growth opportunity there, and we don't think it's the right time. And then finally, we think they should exit their military housing business in the US, which is a legacy business. And when you put those things together, we think that could create an opportunity for Lend-Lease to bring back something like $2.6 billion of capital, which will really fortify their balance sheet. They'll go from having one of the weakest balance sheets in the real estate sector to one of the strongest. They'll essentially be in a net cash position. And more importantly, I think that leaves Lend-Lease as a much more focused business, and what's left is really their areas of core competency where they've got genuine competitive advantages.
It's a compelling argument that this shrink to greatness, look at where their strengths lie and hone in on that. But what are the risks to this thesis?
The key risk for Lend-Lease and our strategy in terms of their transition to a more capital light, more focused business is really acting decisively. Time is not on their side, and we're now operating in a very tough environment. So we've been incredibly focused on their balance sheet, and the key thing we're watching at the moment is the non-core asset sales program that the company is executing. So they're looking to execute the sale of their communities business, their retirement business, taking capital out of an asset in China, and then exiting their military housing business. That's not all going to be done overnight, but we're really pleased that there are processes underway to execute on all of those initiatives. Look, as a high conviction investor, we're having extensive engagement with the company. and we're well aware of the other conversations they're having with other major shareholders on similar issues.
And Misha, with turnaround stories, sometimes it doesn't always pan out as the investor hopes. What gives you confidence that this time around, Lendlease are ready to shrink and ready to be decisive?
Yeah, look, I think the key thing is the strategy we outlined in our white paper is broadly consistent with Lendlease's own strategy. So the focus for us, as I said earlier, is for Lendlease to become more decisive in executing that strategy. And I think we're starting to see a lot more action on that front. So the asset sales are absolutely fundamental to fortifying their balance sheet. And then at their full year result in August this year, we saw some additional positive developments in terms of their strategy. So as an example, they came out and outlined an additional $150 million of cost out. That's on top of some of the cost out that's already taken place. The tone in terms of their messaging has really shifted from capital deployment to capital preservation, which we're obviously very pleased to hear. And then finally, in their construction business, they're really narrowing the focus of that business. So they're winding back from offshore, where some of their activities just haven't been profitable. And they've also committed to stop bidding for third-party construction work in residential, where the risk-reward profile just hasn't been attractive to date.
Thank you so much, Misha, for your insights. It's a compelling white paper that you put together, and we'll be tracking this story with great interest.
Thank you.